Michael Burry, in a recently deleted tweet, explains what he expects to happen to the stock market. This information educates and can make or break your portfolio. Unfortunately, this tweet spells all sorts of bad news. Burry begins the tweet by saying, quote, "adjusted for inflation." But what does that exactly mean? We all know that inflation is whenever the cost of living becomes more expensive and the buying power of a currency becomes weaker. This should be priced into the stock price to get the real, more accurate stock price. However, inflation isn't usually priced into stock markets, which can give misleading numbers as the growth and decline of a stock price happen. For example, let's say that a company's share price increased by 10% in the last year, and this inflation was at 2%. If we ended up adjusting for inflation, then the company only really gains 7.8%. The exact calculation kind of looks like this. Now, let's say that a company's share price increased by 5% in the last year, and the inflation rate was at 2%. If we were to adjust for inflation, then the company actually loses 7%, which is inflation-adjusted return. The exact calculation is going to break down like this. Coming back to the beginning of Burry's tweet, whenever he tells us that the decrease in the assets mentioned in his tweets were actually adjusted for inflation, he's saying that this is the real price drop. Understanding multiple and earning compressions. As Burry stated in the next interesting part of his tweet, the S&P 500 has dropped almost 26%, NASDAQ 35%, and Bitcoin 65% from their all-time highs. It's pretty clear that this is a substantial drop. Then, he adds an extremely important observation, and that is that this drop was caused by multiple compression. The exact definition of multiple compression is an effect that occurs when a company's earnings increase, but its stock price does not move in response to it, or when the stock price falls and the earnings stay the same. Multiple compression appears in a simple equation, which allows us to calculate a stock price. The equation is price equals earnings times multiple, where the earnings are how much the company has made, and the multiple is how much the company is going through those earnings over a year-to-year basis or quarter-to-quarter basis. Firstly, let's understand what exactly earnings are and how it's used in this equation. Earnings, or earnings per share, EPS, is calculated by taking the net income of a company and then dividing it by the number of shares outstanding, which is the amount of shares not owned by investors. For example, if a company makes $100 million and has $200 million shares outstanding, then the current EPS would be 0.5. Now, let's say that the company had a good following year and made $500 million, and the number of shares outstanding dropped to about 100 million because more people wanted to be a part of the company. Now, the EPS of the company would be 5. What this signifies is that the company had increased its earnings and thus tells us that the company is doing well. In relation to the tweets, earnings are what's driving Burry's thoughts on why the market is going to continue downward. While we're on the topic of a company having a better earnings year over year, we can understand the second part of the price equation. Price equals earnings times multiple. The way that the multiple is calculated is by dividing the stock's price by the earnings per share. So, let's say that the company from our previous example is priced at $10 a share. So, if we put in our values into the multiple equation, multiple equals $10, which is the price, divided by 0.5 EPS, then in our first year, the multiple would be 20. And that means that the people are willing to pay $20 for every $1 the company earns. Now, let's say that the price per share moved up to $20 in the second year because people became more interested in the company. So, following the multiple equations, the multiple would then be 4 multiple equals $20 per price divided by 5 EPS. And that means that the people are now willing to pay $4 as per the multiple equation for every $1 the company earned. But keep in mind here, the company has grown 100% from $10 to $20, and people are still willing to pay. Now that we understand how earnings and multiples are calculated, we can calculate the price of a stock with the original equation, price equals earnings times multiple. From the example that we've been using, let's say that in the first year that the company's EPS is 0.5 and the multiple is 20. This means that the current price is $10, just like what we said. If we do the same equation for the second year, the EPS being 5 and multiple being 4, we see that the price is 20. So, what does this have to do with Burry's tweet? Well, it tells us that if a company's multiple goes down, then you can expect a drop just like Burry had stated. So, now that the relationship between earnings and multiples is understood, we can see how the changes between earnings and a company's growth have a huge impact on the price. If the earnings go up, but the multiples don't, then the prices are at a standstill, or they start moving down, and that's exactly what multiple compression is, and what's causing the initial downward move of the indexes and Bitcoin. However, a drop in multiples is often an indicator that earnings are soon to fall too. Multiple compressions are the growth of a company's slowdown, but earnings compressions happen whenever the earnings begin decreasing. Naturally, this ends up pushing prices down even further, and according to Burry's predictions, the prices are expected to go down another 50%. Let's say that a company's current EPS is 1 and the multiple is 15. That would make the stock price at $15 a share. However, let's say that in the second year, the multiple dropped to 10, but the EPS stayed at 1. Now, the price is $10 per share. Finally, if the EPS dropped to 0.5 and the multiple drops again to 5, the price of the stock is now only $2.50 per share. As you can see, the relationship between price and earnings goes hand in hand. How you can still make money in the worst possible situations, there are two things to consider here. Firstly, Michael Burry can definitely be wrong on this short-term speculative prediction. Secondly, taking advantage of what's known as dollar cost averaging, or DCA, can help make you money whether the market is booming or completely crashing. The way that the dollar cost averaging works is that you invest equal amounts of money into an investment of your choice, like shares or index funds, at regular intervals monthly, bi-weekly, or even weekly. For example, you could end up placing $50 bi-weekly into an index fund recommended by Warren Buffett called Vanguard 500 Index Fund Admiral Shares. This is an investment instrument that helps to bundle stocks together into one track and index, like the S&P 500, mitigating the risk of buying on singular companies. What DCA does is it takes away the worry of trying to time the market for highs and lows. This allows you to buy shares both when prices are high or low, since the word averaging and dollar cost averaging. So, in case Burry is right, then you'll basically be buying shares of a company for around 50% of what it was originally valued at. If you want to learn more about dollar cost averaging, then check out our video on DCA.